Thank you, everyone, for joining us today for the 2026 Home Ownership Day. It's always a beautiful Saturday when we get to do this. We do it in January because we are starting off a new year and we're starting fresh and we're thinking about our big, audacious long term goals. Thank you to everybody who's joining in today. We are all passionate about home ownership in different ways, and I'm just really excited to talk with all of you and have kind of a casual coffee conversation and a real estate roundtable this morning about our topic of generational wealth. So, we have a couple of speakers today, Derek Beisner and Amy Shaw. Thank you guys for joining us. Derek is a lender and he is fabulous. He's a certified mortgage planner as well, and Amy is a amazing estate planning attorney, and that is a huge part of generational wealth. We also have our sponsors today that I'd like to thank: Vow to Save and Flower Done NFT. Thank you so much. Give them a wave and a follow. Make sure you follow the speakers too. We have a lot of other speakers that are on our website. They just aren't necessarily able to join in on our X Space today. So that's one of the things that I want to go over is kind of like what you can expect from Homeownership Day. But before I go into all that, I want to tell you just a little tidbit about the history of this event, because this is actually our 15th annual Homeownership Day. We started off IRL in basically the in Chapman University, of all places, with our Young Professionals Network and the Orange County Register back when people read the newspaper, because it was that long ago. So it's something that you can definitely hopefully get on board with the fact that we are passionate for doing this every single year. And we always try to bring in people from the community, not just real estate experts or buyers, sellers, investors, like just everybody, because everybody deserves to own a home. And that is the whole concept of Homeownership Day, is making smart decisions in real estate. And so each year for the last 15 years, we've curated different speakers, different content, different information that's relevant to what is happening in the real estate market at this point in time. So today will be no different. A big topic that I'm hearing so much about right now is generational wealth. We have the silver tsunami. Boomers are retiring. Boomers are needing to go to long-term care facilities, and we are doing a huge transfer of wealth in the US right now and over the next 15 or 20 years. So I've brought in Amy and Derek to really talk about that and help us to make the most of all of this hard work that we've been doing with home ownership. So a couple of expectations, just so that you kind of understand how today will roll, is you're going to definitely learn something about real estate. I learn something about real estate every single time that I'm in here and I do real estate. So I guarantee you're going to learn a little something. And we are basically a casual coffee conversation. So we encourage you guys to join in. Homeownership Day is informal and fun. We want to hear your stories. We want to hear your lessons. We want to hear your goals. That said, we are all about education. So you're going to have formal classes and sessions, training on our sessions and session replay page of homeownershipday.com. So if you have not been to homeownershipday.com before, make sure that you bring up the website and you start to kind of look at which sessions you'd like to download and engage in. And it's actually not a download, you just, log in. It's kind of you know, behind the gate, but you just log in and there's no charge, and it's all great information, and you get to choose your own adventure so you don't get, down a rabbit hole of something that you don't care about. And then if you haven't been to Homeownership Day in a couple years, we have, kind of graduated from where you can, uh, our previous platform of YouTube, which is we just, posted all the videos up on YouTube, and we've really tried to step up our game with a true e-learning platform right now. You guys can log into that and you can watch these sessions in modules. It's easier for you to take notes, and you can get a little certificate at the end of completion. You will need to register for the sessions that you watch, but no, you will not be spammed or prospected in any way, because this event is really all about you and helping you reach your highest potential through real estate, you guys. We're also playing just a little game today, and if you want to engage in that, you'll see I did a post on my Angie Weeks profile about what year you bought your first property and what you paid for it. I'd love it if you guys commented on that, because that right there in itself is just an educational element for the people that don't take the time to listen, but they take the time to read the comments and they're like, whoa. So, as we move along here, I want to officially introduce our MC, Alan. He is on the Homeownership D profile for us today because I am not excellent at multitasking at all. And so he will be bringing people in and out of the space, making sure that we don't have any trolley trolls, and just helping us move things along on a technical level. I thank you so much, Alan, because this way I can try to stay as focused as possible and kind of go just with the real estate content instead of like who's doing what and what do I have to do. So thank you, Alan. Did you want to talk about the best practices in X and Twitter spaces, because I know not everybody here is really familiar with that?
Absolutely. So we'll start with if you're new to X, if you would like to speak, the little microphone in the bottom left-hand corner of your screen. If it's red, you're not a speaker. Click that to request to come up. When it's red, it's off. When it's blue, it's on, like mine is right now. If you're on your phone and you would like to raise your hand, because X doesn't play well when two people are speaking at the same time, so please be orderly about that. Click the little heart at the bottom, and then you'll see a whole bunch of emojis come up on the far right-hand side. You'll see there's a raised hand. Just click on that like I just did as an example, and we'll call on you as soon as possible. If you're, again, using a new account, make sure if you want to speak that you're logged into your account and that you have went into your settings and allowed the microphone function through the settings on your phone. Let's see what else here. Yeah, make sure your mic's connected. Okay. This session is recorded too, so keep that in mind as you're sharing your opinions and letting things fly. If things get heated as far as differences go and so on, it will be recorded and shared back later. And make sure to mute yourself when you're not speaking. A lot of times it'll cause backfeed through the phone system. These are basically a very complex phone call. So that covers the basics. Ange, if anyone has any questions later on, I'm happy to answer them or make suggestions along the way if we run into any kind of snags or sticking points.
Thank you so much, Alan. I know that Derek is a listener right now, and I think we've sent him an invitation to be a speaker, but if you could
I
help
just
him.
sent him another.
Okay. So hopefully he can, and what does he need to do to click to
It
become?
should pop up at the top of his screen and say invited to speak. If he just clicks on that blue oblong oval shape thing there, it should bring him up as a speaker at that point. If not, he can click the microphone in the bottom left-hand corner, and that will send a request to speak to either of us, and we can accept him that way as well.
Okay. All right. Sounds good. All righty. Well, I want to mention our topics of discussion for 2026. They're in no particular order, but we'll be, kind of discussing real estate updates, estate planning, monolithic dome homes, how to quickly spot bad land, buying in the off season, tips for building generational wealth. I've got 5 good ones for you guys. and leveraging your mortgage and interest rates. So, we're also going to talk about what the market's expected to do in 2026 and get a little philosophical about where we think real estate and rates are headed in the future. Um, and we always like to know more about you guys that are listening. So, we love it. Tell us what state you're listening from and let us know if you have any burning real estate questions. We are all truly here today to help build generational wealth for you. And so, if there's anything specific that you want to know, feel free to ask, to, comment, and we'll definitely get to that. We want to know, where you're stuck, where you want to go, and more about your big, audacious goals. And the way we kind of work is this event is here. We chat on spaces about the highlights of the recorded sessions, but by no means is everything that we discuss today in this next, hour and 45 minutes going to cover all of the great information that are in the downloadable login sessions on the Homeownership Day website. So remember to go to homeownershipday.com/sessions for kind of like the full enchilada, let's say. All right. So before we really dive too deep into our generational wealth strategies, how about we talk about the real estate market and interest rates? Each year, I think it's kind of fun to get real time updates from agents and lenders who are working in the field, or any of you who are currently like in the middle of buying and selling. Anybody want to start with an update on what they're seeing in the market right now?
Yeah, Angie, Derek Beisner, how you doing?
Good. How are you, Derek?
Finally figured out the mic. Thank you for that. But
Thanks,
yeah, I'm
Alan.
with Summit. I'm a Summit mortgage guy, and what I see is rates hovering right below 6%.
That's
Okay.
great.
Yeah, I'm working on one right now, and I'll just kind of give you a little. You know, he's we're refinancing him, create a little generational wealth as well for him.
Mm-hmm.
Lowering his term to 25 years, and over the next 25 years, lowering his rate as well. He's going to save $293,000 on his loan. Obviously, creating generational wealth for him to have X amount of more money if and when he ever sells. Yeah. So.
That's amazing. And that's like, it's just people really don't understand that difference in rates. Like 1 point can be, what did you say, 200 and almost $50,000?
Well, a lot of people think you have to be 1 or 2% below the market. What I will tell you right now is everybody's different,
Mm-hmm.
you know, and I can tell you that I offer mortgage reviews, that all day long.
Right.
Certified mortgage planner.
Mm-hmm.
Everybody's different. If you're currently paying 6.5% and above, you really should take a look at see where the rates are at now, because we'll figure out if it makes sense or not for you to refinance. How many months it's going to take for you to recoup your costs.
Mm-hmm. And I love
So
it that
obviously,
you do that analysis because it really helps people just kind of delve in to see exactly, okay, this is what it would look like if I stay where I'm at right now, and this is what it would look like if I change over. And it's it's just great that you can give them that side by side comparison and help them to have a true understanding about what those numbers are like. Because I am not a numbers person. I'm glad to have you in my
well,
life.
that's kind of why I do what I do. It's my why, but
Yeah.
changing lives every day, obviously, like we do. But
Hmm.
I will give you, one little thing is just, whoever's out there, just make sure your credit score is good,
Hmm.
because the better the credit score, the better the rate. It is what it is.
Hmm.
We're lowered. We go as low as 580 now,
Okay.
but I'd love to see everybody be above 740,
Okay.
and I think we'll have the golden ticket when it goes to get yourself a rate in the future. Yeah.
Okay.
So
So basically you can get your foot in the door at a 580 at this point in time, but you're really getting like the A paper loan if you're a 740 or higher.
correct. And so to kind of give you a little, what I got a couple notes here if you want me just to keep going. You don't need 20% to buy.
Sure, sure.
That's a myth. You do not need 20% to buy. I've talked to plenty of people said, yeah, I'm going to buy in 2027 when I save my 20%. You don't need it. You can buy for as little as 5% down.
Mm-hmm.
And it could be all 100% gift from an employer or a family member.
Okay.
100%.
Oh,
Yeah.
so employers can
And
gift it too. Okay.
right. Yeah. Yeah.
That's
And
good.
so I like the 5% down compared to the FHA.
Mm-hmm.
Uh, The mortgage insurance is a lot cheaper.
Okay.
And on mortgage and FHA, you got that mortgage insurance premium up front.
Mm-hmm.
On anything, it's 1.75 of the loan amount. And so you'll never get that back.
Got it. Do you want
So
to
I'd like,
explain a little bit more about mortgage insurance and what that is to the people in the room here, Derek?
yeah. So when you're buying FHA, it's 3.5% down. We'll look at that option, but if I compared it to a 5% conventional financing, your payment's going to be much cheaper
Mm-hmm.
because the 1.75, it's called MIP, Mortgage Insurance Premium FHA, is added to the loan amount. There's nothing added on a conventional. So mortgage insurance usually comes into play when you're not putting 20% down, but the FHA mortgage insurance is higher than the conventional mortgage insurance. I just quoted one the other day. I think the mortgage insurance was $100 a month. And they didn't have 20%, but they had good credit.
Mm-hmm.
So that's what I kind of do to help you guys out as well. And eventually when you get to 78% loan to value, we call what you owe compared to what it's worth,
Mm-hmm.
you could just have the lender take the mortgage insurance off.
Right. And that was a really fun day for me. When we bought the Michigan property, that was my grandparents. I had mortgage insurance. I think we did 10% down on that one. And so I called and I said, when can we drop this? And they said, 2 years, or, when you're above this number. So I just set an alarm on my phone for 2 years. And then I called them in 2 years, and we had to pay for an appraisal, but they dropped that couple $100 that we were paying off, um, for the mortgage insurance off that mortgage.
Yeah.
And so,
I would say whoever's a homeowner out there, you should just, in your mindset, when you're reviewing your taxes,
hmm
in April,
hmm
you should just contact your lender and see where you're at. Check the value,
hmm
check your balance, check your loan to value, see if there's any way you can get a lower payment.
right,
Yeah,
exactly.
an annual thing.
And
Yeah,
now, so,
and anybody can put 6% down, 7%, 12%, 17%. It doesn't have to be just 5%. It can be anywhere from 5 to 20. Anything they want.
hmm which is, that's different for everybody. It's where their comfort zone lies. And
Correct.
a lot of times, what I'm telling you when I'm sending you a potential buyer is, I need you to work it back from what their monthly affordable payment is, and then you
Correct.
tell them
What
how
they
much they need to
qualify
put
for.
down.
Right.
Mhm.
Qualify what you qualify for. Now, FHA, back to mortgage insurance, you'll never get rid of the mortgage insurance on an FHA loan until you refinance out of the FHA
Right.
and into a conventional 30-year fixed.
Mm-hmm. Mm-hmm.
But it's a good starter.
It's better than renting, in my opinion.
Absolutely. Yeah.
It's just, but if you can go with the 5% down where you can get the mortgage insurance dropped, because it is, we have a FHA loan on our Santa Ana property, and we've held that for over 10 years now, or no, this is the 10th year. And so, but there's no way to take off the mortgage insurance unless I refinance, but my rate is 4.5% and I can't get that rate again. So it
So
doesn't make, you run into this conundrum sometimes, and it's a good problem to have, but it's just, you
absolutely.
know.
So when you're talking the mortgage insurance premium on FHA, if it's 7/8 to the rate, so you're actually 4.5, you're at 5 3/8 right now.
Hmm, good to know. Thank you.
Yeah.
Yeah, and so like these numbers, it can get confusing for you guys if you're not that familiar with it, but that's why you want to have a lender in your corner that you know and that you trust and that you can call and ask these things to. One of the things I love about Derek is he actually works weekends, because here he is on a Saturday morning with us. And that is, it's something that's super helpful. And I think that just our market right now is in a good, healthy space, finally. Last year, we were not in the most healthy of market because our interest rates were completely terrible. And now that they've gone down a little bit, we are in a much healthier market. And that is also, if you guys decide that you want to look at Stephen Thomas's session here on the Homeownership Day sessions page, he will go into that with you as well. He's a great forecaster here in the Orange County area, but he does forecasts for like Vegas and Northern California, and I think even Florida now too. So he's really expanding across the country with reports on housing. I purchased the reports on housing monthly subscription. So if any of you ever have interest in knowing what the report is this month, just message me. You can get on my list, or you can purchase the reports yourself. But I find them to be highly valuable and helpful in us knowing what is going to happen. And so Stephen obviously doesn't have a crystal ball, but one thing I will tell you is he is not forecasting doom and gloom this year. And so that's something that we're really happy to know. And it should be, it should be a good year for everybody. Not like too good in the way of like beating up the buyers and the sellers just raking in cash, but also not too good as in buyers you get $100,000 less than you would have paid last year or anything like that. They're not forecasting prices to go down, but just up a little bit, which is kind of what we want real estate to continue to do. So I would encourage you guys to listen to that session. I When we talk about kind of where the market's going and all that stuff, it's important, but really one of the more important thing is the big long-term challenges with your family and how they're going to transfer their wealth, and including leaving out everyone's least favorite uncle, Uncle Sam. So today I want to also bring up Amy Shaw. She is an amazing estate planning attorney, and she's joining us also on her Saturday. Thank you, Amy, for doing that. Um, we just want to talk with you about some of your session tips on how estate planning protects and maximizes real estate assets. We know that what you do is an absolute must for anyone that is planning to purchase property or pass it along. So tell the group what they need to know, Amy, so that they can make smart decisions in real estate when it comes to their wealth.
Well, it's always good to have a plan when it comes to accumulating your wealth. And then you don't want the government to get any of your money. You don't want attorney's fees to diminish your properties when you're passing it down and things like that. So an estate plan is super important. And having a trust, especially if you have properties in California, in most states, it is very important because it'll be you're able to pass it down to your next generation without paying those extra attorney's fees, court fees. And I mean, if something were to happen to you, nobody else has control over your properties. You need to have the plan in place so that somebody can immediately take over, manage them. If you have rental properties, you need somebody to manage your properties, and you need someone to have control over those, because you're just going to let money out the door if something were to happen to you and you're in a standstill for months and months and months on end until somebody can be appointed to be in charge of all of this. So I think that's kind of a huge advantage. And then on top of it, it gives you flexibility in terms of passing it on to future generations. I mean, the point of accumulating all this wealth is to build that generational wealth and to be able to pass it down to your future generations. And so it's really important to have that and be able to have the flexibility in terms of how you want it passed down. You can keep it in your trust so that there's less disputes over the property. There'll be one person, which is your successor trustee, to make the big decisions about the property and distribute monies to your beneficiaries if that's the plan, or to be able to divvy up properties and things like that. And then I think the other big part is, in California especially, is to maintain your low property taxes. And now that the laws have changed on how you can keep your property taxes low, it's really important to speak to an attorney and have your estate plan in order so that you know what you have to do to keep those taxes low.
Thank you. I agree with that, and just the whole tax thing, that's like another whole area of expertise that people just really don't understand. But I like it took me so many people telling me so many times and actually seeing it happen to a friend until I really understood like how important a trust is and how important putting your property in a trust is, because if not, when you pass and you if you still have a mortgage, then one of your family members has to pay that mortgage or else you're like going into default.
Yes.
And it's, you know,
Absolutely.
it's
And that happens because
Mhm.
nobody knows who's in charge at that point. So let's say you don't have a plan, you have a number of different beneficiaries. Sometimes they're fighting over things, but somebody will have to apply to the court, petition to the court to be appointed the representative of your estate. And there could be multiple people that do that. It could take years to resolve sometimes. And all this time, nobody's in charge of your property. If it goes into default at this point, it can happen. We've had properties that have gone into default because there were issues in terms of who was going to be appointed as a personal representative. And it took almost a year to resolve that. So,
Exactly. And that's like I had a couple properties that I was working on selling. It was over a year that it was we were waiting to even be able to get the proper people assigned from the courts to allow us to sell the properties. And then we had to wait when we got potential buyers for them to confirm that those buyers were paying enough for the properties. And then the properties didn't have that much equity in them. And the courts charged the family. What was the percentage you had said in your?
it it depends.
Mhm.
Attorney's fees, executor's fees, court fees can be at least up to 4 to 10% of the fair market value of your estate. So it doesn't even mean the equity of your estate. So let's say you have a property that you bought it for, I mean, you have a high mortgage on it. You bought it
Mhm.
for $1 million. Your mortgage is, let's say, $900,000 on it. But the percentage of what you're going to pay is going to be based on the $1 million, not the $100,000 equity you have in your property. So that could really diminish the what you have, and it could
Right.
take up most of it because guess who gets paid first? Taxes, attorneys, courts.
Right, not you. Well, the
Yep.
attorney, you as the attorney get paid first, but not you as the homeowner. You don't get paid
Correct.
first. And so it's like, but if on the other hand, if a property is in a trust and something happens, then everything is already like boom, boom, boom. This happens, this happens, this happens. You
Correct.
contact the attorney and everything just flows, right, Amy?
Yes, and you have somebody that you've already put as your successor trustee. Once you pass away, that person automatically takes over. All they have to do is, show your death certificate, your trust, and show that they're next in line, and they automatically are able to take control of the property. If there are disputes, then, your beneficiaries are going to have to petition, file a lawsuit to even do anything. But until that lawsuit is settled, that successor trustee is still going to be in control of your property. So they're able to manage it. They're able to take care of the things that need to be done. They're able to do everything on it. So that's a huge advantage because then things are not in limbo for so long, even if
Right.
there are disputes.
Right, exactly. And that's, you want to be able to maintain as much of your hard work and efforts as possible. And
Right.
just, a little bit of planning goes so far with when it comes to transferring your property portfolio. And you don't
Hmm.
want a lot of these property, I mean, sometimes these properties are like built by their with their own hands by
Yeah.
your grandparents. Like, you want to make sure that that all is something that you're protecting, you guys. So I encourage everybody here, an action item today is to check and make sure that your property is in a trust. If it's not in a trust, if you don't know what that is, please follow Amy. Please message her, give her a call, and set up your family trust. Even if you only have one property, I say only, it's a huge accomplishment to have one property, but you should still have a trust because that property is something that is definitely worth value no matter what state it's in or where it's at. And you want to make sure that that whole value goes to your family, not to Uncle Sam. And choosing not to make a decision, choosing not to put your property into a trust is choosing to hand money to Uncle Sam. So I want you guys to just remember that. And we don't want to do that. Amy, do you have any like favorite clients that have done anything creative with their trusts? Like, I've heard of like people saying, all right, you inherit the property and you're not allowed to sell it for 5 years because I want you to see the value of getting this residual rental income. Or, do you have any families that are doing anything creative like that?
Yes, absolutely. And there's some properties that have been in families for generations and they want to keep it in there. So you can put in there that these properties, they want to hold them for certain periods of time. They want them to go down the family line. There are certain things that you can put in there. There's also I mean, not just as it relates to property. Well, I guess with property, you can say if your beneficiaries want to live in the property, you can put conditions on that. You can have your children live rent free in the property for a certain amount of years, things like that too. So there's a lot of flexibility. Whatever you want to put in there, we can talk about putting it in there as long as it's not either against the law or against public policy. You can put it in there. There's restrictions you can put, or there's desires that you can express in there. Like, I want this to be. I just had a client actually. Their property was from like great grandmother, and they want to keep it in the family line. And so they've all created their own trusts to keep them funneling it down the family line. And so you can also do that. Um, one of the
I
one of
love that.
the grandchildren, yeah, doesn't even have any children. And so once he passes away, it will go to nieces and nephews because that's down the bloodline. So mhm,
I love that. And that is such a, like, that is the true essence of generational wealth, you guys. Like,
yeah.
it's fun when we play the little game of what I bought this property for and what it's
Hmm.
worth today. But, like, the jaw dropping game is like, what did your grandparents buy their property
Yeah.
for and what is it worth today? Because we are not talking tens of thousands of dollars in that case. We are talking hundreds of thousands of dollars. And
Right.
that's
And
what
this
we want to
property,
get for everybody.
yeah, and this property was in San Clemente and it was built by their great grandparents. So it was
Oh.
very, I mean, everybody wants to keep it there. They want that property to stay in the family line. So it's good.
That's so special. Like,
Hmm.
it definitely should stay in the family line, and I'm glad that they're like working with you and planning and preparing to do that.
Yeah.
You guys all make sure, please follow at Amy Shaw Law. She got on X just to be with us today. So thank you, Amy, for that. We appreciate it.
Well, thank you.
Yeah, I hope that you'll stay on. Well, do you mind staying on? And does anybody have
Yeah, I will
questions
stay on.
about wills and trusts that they want to bring up at this point in time? I know it's like it can be a super confusing subject, but feel free. Does anybody have any questions that they'd like to ask Amy? Are you thinking about setting one up? I know like funding the trust can be something that people forget to do, or do you guys have any questions at all that you want to bring up? Don't be shy.
And even if you have any questions later on that come up, please email me. I'm happy to answer questions. You can give me a call, email me. I am always available.
Good, good. I love that. Well, you guys can just, raise your hand if you have a question as we go through, speaking more, and you can bring stuff up, and hopefully Amy and Derek can stay for until the end, and we'll come on all of these subjects in a little bit of a different angle throughout the rest of our home ownership day today. But it's like, I just can't stress enough the importance of the having a trust, and a will is not good enough. So definitely, you guys, make sure that you check your paperwork on that level. Let's see here. I just got a little pop up. I think it's okay. Like, my phone is doing things.
Yeah, it was just Amanda coming up.
Oh, hi, Amanda.
Hi, can you hear me?
I can.
Yep.
Welcome,
Oh, awesome.
welcome.
Yay. I didn't know how to do this. You said if you had any questions, and I was like, I do, but I didn't know how to do this. So I requested it this way.
You figured it out.
I did. So I am curious. My mom has her house in what's called a quitclaim deed. And I was curious what's the difference between that and a trust?
Well, I'm not really sure. Is it like a quit claim deed, or is it like kind of like a ladybird deed? Is it like if she passes away, it get transferred to somebody? Because that's called a ladybird deed. A quit claim deed is only something that passes along to you as much as the previous owner has. So if she has a property that's quit claim to her in her personal name, that's not in a trust, that's not in anything. So it doesn't do anything. So it's just in her individual name. She would have to transfer that, or create a trust and transfer that into her trust for her to actually create a plan to, pass it down.
Okay, she was under the impression that a quitclaim deed would make it easier for me and my brother when she does pass to take ownership of the home. So I don't know if she was
No.
given bad information or what, because she kept saying quitclaim deed to me, and I was like, okay, I don't understand what this is about, but I
Well,
will.
if you want to text me or email me or message me her address, I can I can pull her deed and
Oh,
see what that deed says, and then I
great.
can tell you what it does.
Yeah, absolutely. Is your email on here somewhere?
It's Amy at amyshawlaw.com. I
Okay,
can
sure.
let me see.
And I was going to say, as far as I know, and I'm not sure if Hannah, our title rep, is in the room, but request to be a speaker if you are, Hannah, because you could probably weigh in on this. But a quick claim deed is usually someone going off of the title, and you have to still be alive to make that happen. You like sign that, and because I see quick claim deeds happen a lot with divorces, when the property is already paid off and one person needs to quit claim off the deed and they're leaving someone else on it.
Oh, interesting. Okay.
But
Yes,
maybe
so
she put
a
you
quit
guys both
claim
on the,
deed.
I don't
So
know.
there's different kinds of deeds. A quit claim deed, there's a grant deed. So a grant deed gives you the most guarantees and protections on your ownership of the property. A quit claim deed is like, well, I don't know what interest was there, but I'm passing along what I have.
Okay.
You see what I'm saying?
Uh-huh.
Yeah.
Okay.
So, but yeah, email me the address. I
Okay.
can pull the deed and I can tell you what it is
Perfect.
and
I
what it
will do
does.
that. Thank you
Okay.
so much.
Yeah, no problem.
All right.
Thank you for asking that question, Amanda. It reminds me of one of my recent sales. Well, not recent, it was probably about 5 years ago, but the owner of the property walked into the city of Santa Ana and said that they wanted to make sure that their children were not receiving the property tax bill because they had put the property tax in they they had basically put the property in the kids' names so
Uh-huh.
that that wouldn't happen, which that's not always something that they're, a good idea anyway. And this person at the city basically messed up the deed to the point where then the property had to go into probate. And so she got bad advice from somebody at the city and thought that she was talking to a professional that knew what they were doing,
Mhm.
and it messed up the whole thing. So, and
Wow.
so many of our like senior parents are not, they're like, they try to be frugal and they get advice from somebody that's not the attorney because they don't want to pay the attorney for an hour. And it's like tens and thousands or hundreds of thousands of dollars that, they're missing out on. So if you guys have older parents, like, don't be afraid to like be like, let's go make a appointment with the estate planning attorney together, you guys. Like, let's get this done. It's a very important thing to do for the family because it's confusing. Like, Amy knows her stuff, but like it is very confusing. And so trying to get down to the bottom of it and make sure that you've got everything planned out right in all the different scenarios, it's important.
And
So
Andy, you bring up a really good point. Do not put your kids on your deed just to save on probate.
right.
Do not do that until you speak to an attorney, because you will be paying more on taxes
Mm-hmm.
for that, capital gains. There's a lot of benefits to inheriting a property versus just putting your kid's name on a property. And there's better vehicles to do that, and that will save you money. So please, please, please don't do that until you speak to a professional.
Yes, I agree with that completely. And people are just like, oh, that's the easy button. I'll just add them on title
Yeah.
right now while I'm still alive. And it's like, that is, sure, it's an easy button. It is a very freaking expensive easy button.
Yes,
Like,
it is.
don't press that button. It's a bad idea. Oh, goodness. Oh,
I
I just
agree.
saw Hannah pop in, but Hannah, if I sent you an invite to speak, if you want to become a speaker, you just accept that. And then Amanda had a question about like her mom having a quit claim deed and thinking that that is something that is a good idea for the property to, transfer hands. But if you want to speak to that, feel free at your convenience, though. But let's move along. We've got like,
Real quick,
yeah,
Angie, I put my hand up. I
sorry,
just want
Alan.
to do some quick housekeeping and
Yeah.
remind everyone to please retweet the space, and also point out that Amy Shaw shared her email address in the comments down there. And the bios for all of our speakers are pinned at the top tonight, or this afternoon. So feel free to check those out as well. I also retweeted Amy's email address from the Homeowners Ship Day account, so that that's easy to find in the future in case someone forgets during the space.
Thank you, Alan. I appreciate that. See why we have him? He like always remembers the like important logistics that I forget. And thank you for commenting your email address, Amy. It's really great that you be willing to, help these guys that want to reach out to you with some advice and direction. That's amazing. I want to talk for a second too about basically like uh, I want to bring us back to Derek's session about leveraging your mortgage to build generational wealth. That's something that not a lot of people talk about, but if you've been with us at previous homeownership days, you've heard Derek speak before, and he's got decades of mortgage experience, and he always contributes here. And some of the highlights that he had in his session are, I just wanted to like bring up really quick. He talks about paying your mortgage down early. That if you pay your mortgage down early, you guys, you can reinvest that money that you would have paid an interest into another property, into so many other things that could really help build out your generational wealth. So, Derek, are you still available? You want to talk a minute about what it looks like to pay down your mortgage early, some tips on that?
Well, yeah. So I was talking about the client who I'm working with now. He's at a 28 years, 2 years into his loan, right? So we put him into a 25. and we lowered his rate. I'm saving about $300 a month, but over the next 25 years, he's saving $293,000. An interest that would have been paid on that rate anyhow, and just for that particular into the bank. So in theory, if he wanted to sell his property, right, he should have an extra 290, or if he wants to do something in the future, he should have an extra $293,000, right, on his family P&L. So that's one way of looking at it. And then, we all have a bunch of equity. You may have a great rate, like Angie mentioned, you're at 4.5%. But if you're not, you may want to think about pulling some cash out and, maybe buying a 1 to 4 unit, living in one of them. We talked about this, Angie. We do that with your clients. Live in one of them, take the rents from the other 3, and have your mortgage payment paid. But I'd also want to, if you were making a profit on that rent, we'd want to strategize and put that additional rent funds towards the monthly mortgage and maybe pay that mortgage off in half the time. So when you do go to sell, you own it free and clear.
And I love that concept on the multi-unit. Like, I love it that, you talk about paying down early and continuing to re-leverage and build out the portfolio, because that is like, to me, I think a lot of people think, oh, I've made it, I've bought a home, I'm good, I'm done. But I encourage everybody at Homeownership Day, like, you have just begun when you buy land number 1 or home number 1, and keep pressing on, because where the real wealth happens is on number 2, on number 3, on number 10. Like, that's when you're really going to stack your chips and build out the wealth for the next generation. And multi-units, I really like that concept, because it it's kind of spreads out your risk, right? When you have a single family property, then if your tenant can't pay, 100% of your mortgage payment is unpaid at that point in time. But if you have a fourplex and one tenant can't pay, well, you still have 75%, or sometimes even more, because again, you're not charging them just 1/4 of the mortgage, right? It's, usually you're making more so that you pay less to live in that last unit. So multi-units are just an amazing way to really like fast track building up your wealth. Got like a Grant Cardone thing the other day, and he was talking about multi-units and scaling too. He's like, if you just have 1 or 2, it's just going to beat you up, which he's not completely wrong. It's not easy to be a landlord or a property owner if you're just doing it like for 1 and 2. And that's why you probably have heard a lot of people that have only had 1 or 2 say, gosh, that was a lot of work. But, we do a lot of work to build a lot of wealth. And that's, why we go to work 8 hours a day. And a lot of times these properties will make you more money than going to work, even though you're, just simply passively holding the property. So having these multi-units and keeping them for years and moving them onto the next generation is just like beyond powerful, you guys. It's absolutely beyond powerful. Was anybody know
I see we had
somebody?
Hannah join us.
Oh yeah. Thank you, Hannah.
Hi. Yeah, I didn't want to interrupt earlier. I apologize.
No, all good. Yeah, you want to talk a little bit about like title and deeds, or just any tips that you've seen as a title representative that people are utilizing to build generational wealth?
Yeah, it's a little bit of a tricky oh gosh, tricky situation you could say, just because
Mhm.
my priority and what I usually push is just protecting. So I guess we talk about generational wealth and titles and deed. It's
Mhm.
really just protecting your property, not only before you purchase it, but also after, for the generations to come. So I always recommend putting it in your trust, just to keep it, yeah, protected, I guess is the right way to say
Mhm.
it.
It's a good way to say that, honestly, Hannah, because there's a lot of fraud that goes on, as you know, with titles, and that's why there's a whole title insurance, opportunity, position, job, whatever you want to call it. And people will try to fraud out and pretend to be the owner of a property when they have no business at all in the property, and things have gotten sold that way. So another kind of layer of trust is putting that property into your trust, because when an escrow company goes to sell a property that's in a trust, they usually want to see a copy of the trust, and they ask for more information and more documentation and all of those things. So if your property's only in like your name, then somebody can create a fraudulent ID for you. And if it's a busy escrow and an offsite real estate agent, they might be able to sell a property that is not even theirs. And then you have a title issue, right? So,
Exactly. And it's so important to stay vigilant when we talk also about maybe um investment properties as well. So typically we see fraud when there's a different mailing address, if there's no activity kind of on the property regarding loans or anything. So just staying vigilant about making sure you're seeing all of the notifications. So when something's recorded, you'll get a mailing, get a notice in the mail. And so just an annual check. I mean, I don't want to make it sound all scary and really scare people, but it is important to just check. It's free online, or it might be 50 cents. Check just to make sure nothing new has been recorded on the property if nothing is currently happening.
I agree. It's like this set it and forget it type thing. And that's what we kind of want to do in a way. But we also, like, if we don't track it, then sometimes it just ends up disappearing. And we're like, where did that go? And that's not what we want to happen with our hard earned property.
Absolutely. And it is devastating. Fraud, we try, obviously that's our intent, is to catch it before it happens, but it's devastating to see somebody who's worked so hard for their property kind of find out that somebody's done this to them and they can't, confidently pass it on to their kids, which is what the point was.
Right. It's absolutely terrible if that kind of stuff happens. So, one way, if you guys would like to, one of the things that I'm offering today to Homeownership Day attendees is, if you have an off-site property, out-of-state property, in-state property, I don't care. We have an AI valuation system. So, I can set you on that, and that will give you a little monthly update with what your equity is at on that property. And that will hopefully remind you every once in a while to go and check on your title and make sure everything's looking good there, because you want to track what you're earning and what you're growing on that, and also track and make sure that nobody is trying to take that away from you. All right. Does anybody have any questions at this point in time before we keep moving
Did
along?
you want to ask Amanda to repeat her question now that Hannah's up here and could directly address it?
Oh, are you available, Amanda, or do you want me to just repeat it for you?
Nope, I am available.
Cool.
Um,
Yeah.
so I was curious. My mom said that after my dad passed, she had her home put into what she said was a quit claim deed for me and my brother. Somebody had told her that that was the easiest and that it would bypass probate or something of the sort. I'm not really good with this stuff, but I was curious what the difference between that and a trust is, basically.
Yeah. So a quitclaim deed is just transferring ownership. So it seems like you said, I'm sorry, you said when your dad passed?
Yeah, she had such a difficult time dealing with the paperwork of that she did research. She wanted to make it easier for me and my brother. So that's when she had the
Sure.
claim deed. Apparently, we were put onto it or something.
Yeah, both are good ways to go for sure. The thing with the trust is that it is typically passed down to what they like your heirs, and so there's the possibility of somebody claiming to be a family member and claiming to have some right in it. But the quitclaim deed is just a transfer of ownership. So it sounds like she just transferred it to you, which is a great thing as well, and it totally does bypass anything and doesn't leave anything up to chance.
Oh, okay, great. Is that affecting her? Somebody had said something earlier about it affecting her property taxes, and I know as she gets older on a fixed income, she's struggling to pay the property tax. That doesn't raise the property tax for her, does it?
I don't think so. Don't quote me on that, but I'd be happy to find out for you
Okay.
to get you a solid answer. But I'm pretty sure it doesn't.
Okay, awesome.
I don't think it does unless it like actually gets recorded right now, but
Right.
usually
Yeah, I mean,
if
that it wouldn't make sense to me either. I don't know why it would, but I
It shouldn't.
okay.
I'd still probably bring her into her CPA, Amanda, and also to a trust
Yeah,
attorney because it seems like there's a landmine in there somewhere.
right, right. Okay, I will do that. Thank you.
It smells fishy.
Yeah. Okay.
But
Thank
awesome.
you.
But that, I mean, it is good to know. Thank you. I appreciate your asking the
Sure.
question. Does anybody else have any questions?
I see we had Flower Den come up, one of our sponsors.
Oh, okay. Yeah. Daniel, Flower Dime, what you got for us?
Hey y'all. I don't have a shill or anything, but a question came to mind, especially while we had the three of you up here. Just kind of a hypothetical, like if you wanted to purchase a property and hold it under a trust, what's that sequence or kind of expected timeline if you don't have the trust created and you've identified a property? And maybe to Derek too, like how does it work with like what do you call it, seasoning the funds?
Good point.
Well, I mean, speaking to the estate planning part of it, the thing is with the trust, you can create it before or after. So if you're in the process of buying it, you can get it in your individual name and then we can transfer it afterwards once you set up the trust. It's not a big deal. Like I have clients that do either way. Sometimes if you're contemplating buying a property, I tell you to go ahead and set up your trust so that once you buy it, through title and escrow, whenever you close on your property, they'll have the deed done to transfer it already into your trust, and you don't have to have a second process, right? You don't need a second deed to transfer it. It won't be transferred in your individual name, and then you don't have to transfer it into your trust after that. So, I mean, the timeline in creating a trust usually 30 to 60 days depending on how quickly you can get information, we can get together and things like that. So I mean, it may or may not happen if you're already under contract, and but it's okay to just create it and then transfer your property afterwards.
And as far as the mortgage part of it, I always tell every one of my clients that they don't have a trust because I'm looking at their loan application, right? They're going to go trust single woman, single man, or whatever. Always, always, always tell them to see Amy. Do they listen to me? No, but they should. I can tell you right now, we do lend in a trust. I'm okay with that. And if you do have a trust and you're doing a loan with anybody, just send the certification of the trust to the loan officer, and they can fund that in a trust to where it would take one step out and not have to put in a trust after you funded the loan. Does that make sense, Daniel? You there?
Yeah, it does. Thank you.
And so you mentioned something to do with seasoned funds being seasoned. I didn't quite get that one because it doesn't really have anything to do with funds.
So I think he was asking if the trust was just created like this month. So, and then they want to buy the property in the trust like, does that trust account? I know sometimes, or like if you're buying a normal property, the lender wants to see those funds in your account for at least 2 months, or else where did they come from? They need to be sourced or whatever. So is that the same? Do you guys do that on like a trust bank account as well? And you look for that seasoning to be in there, or?
So you're talking about funds that are put in a trust, not property.
Right, exactly. Now he's talking about buying a property with a trust, like a new property.
You can always, they're always going to ask you to prove where the funds came from, the source of funds, we call it. So if you sold a property, Daniel, and you have a copy of the HUD 1, that would match up to that deposit, it would source it. The one problem you get into if you have cash being cash, that has to be seasoned for 2 months because we do not take cash anymore. Cash is not king. It is not. Yeah, so.
Got it. Yes. Paper trail is king when it comes to lenders, you guys. So if you are like one of the things that we want to talk about is being prepared, right? And a lot of times people are not prepared and somebody drags them into an open house and they fall in love with it and they go, "Oh my God, I must have this right now." And they don't have the preparation in place to get that. So then they're scrambling and being like, "Okay, I need to pull some money from here. I need to pull some money from there, from everywhere in order to get this property." And that's when the lenders go, "Whoa, hold up, where is all
So,
this coming from?"
and so they will not count anything that's cash. It would kill the deal for sure. So it's not a good thing. What if you can kind of think about it? Let's just say you're going to put some funds in today. Today, February, and we're going to ask for 2 months worth of bank statements. So we're going to you're probably going to want to start the loan in.
Oh, it dropped you down, Derek.
Oh,
You
he got
touched
rugged.
something. Or they call it he got rugged. But then I think I'll click to invite him to be a
I
speaker
sent him
again.
one.
Okay, cool. Yeah, but that's that happens on X, but you're welcome back to finish that thought anytime, Derek. We were one of the things that we were kind of talking about or like leading into with all of this and Daniel's question is like timing things, right? You want to time things appropriately so that you can purchase in your trust if ideally, right? Because then that just seems like it's the easiest distance and not have to be trying to close an escrow while you're creating a trust. And so having your trust already created, having your property already in that and available for you to purchase the next property in that. And in addition, being ready and having your finances in order and having that clean cut. And if any of you have ever gotten a loan before, I call it the financial fishbowl, right? You're in the financial fishbowl when you are getting a loan and everybody is looking at every single thing that you are doing with your money. So it's a good idea before you start to purchase to kind of mentally put yourself in the financial fishbowl and clean everything up and make it, look like it's ready, because a lot of times that property that you want, the good deal, comes on before you or it comes on and you're not able like to get it if you're not ready. And so it's about always being ready, always being prepared, always being in the position to be able to have your pre-approval. I was just talking with a guy in my networking group this week that said, I didn't plan to buy a property in Florida, but I was down there on a vacation and I was going to open houses with friends. And then all of a sudden, I now own a property in Florida. And that's kind of how these things happen, especially with second homes and vacation homes. I see Frankie has a hand up. Frankie, do you want to ask a question or have a comment?
Yes. So I'm a property investor. I own about 9 properties, and
Awesome.
what I have done, right? I'm gonna drop a little alpha here. I don't really like to drop a little alpha, but this looks like a space that I'll drop it in. So I took all my properties. Every single property is their own company, and I have a parent company that's in charge of. So I have 10 companies. So I have the parent company in charge of all 9 properties, and then I have an irrevocable trust that's in charge of the parent company, and then I have a revocable trust that's in charge of the irrevocable trust. And I did that for. There's many legal reasons why I did that. Now on top of that, each property has their own bank account. Their own company, they have their own bank account, but the money still goes to the parent company. I just have it because that way, because if you don't keep your properties separated like that, if someone falls on one of your properties and insurance is exhausted, you're going to be forced by the courts to liquidate the rest of your properties until the money satisfies the court judgment. If you keep it that way, the way I did it, when insurance is exhausted, they can't come after you for other properties because it's not in your name, and those properties, they're not attached to each other, even though you do own them. So once you have something like that as a will, so I started off with 3 properties. That's how I did it. So every time I buy a new property, um, when you buy a property, you have to ask the bank, because if you still have a mortgage on it, you have to tell the bank, listen, I want to put this property into my LLC. It's okay, because if you don't put the property, if you don't ask the bank, and the bank finds out that you put this property into LLC, even though it's like, an investment, or even if you bought it as a home property, no matter what, if you don't ask them, they can go and force you to sell that house because you didn't tell them that you wanted to put the property into the LLC, and even though you're still paying on the mortgage. You know what I'm saying? So you have to ask them first. Don't put that into an LLC or into a trust without asking them, because, well, the trust is a little different, but the LLC, you want to do that first because it's all tax, like it all has to do with like taxes and keeping stuff out of probate if you die, and it's there's a lot of legal jargon that I just would take a little bit more to talk about instead of just 2 seconds. But I just wanted to say that. That's all.
Thank you, Frankie. I appreciate that. It's a, he just dropped a good truth bomb on you guys that this is what a lot of my investors do. Basically, every single time they buy a property, they will tell me to write it up in the name of 123 Any Street, comma LLC. And they create a limited liability company for each one of their new properties, and it's a smart idea to do. It makes your bookkeeper happy as well, you guys, because the property then it's like its own little business, and then at the end of the year you can see, did that business do well, or did that business, is that business in the red? And it helps you to kind of keep each and every one of your properties on an individual level accountable but still safe. Sorry, go
Let's see,
ahead.
we also had Black Meta pop up.
Yay, Keely's gonna say something. I love it. And yeah, so okay, I said go. How about Frankie and then Keely?
So also too, there's another thing called DSCR loans, or people call them DCR loans. There's 2 type of DCR loans. There's ones for Airbnb, and there's ones for traditional traditional landlords investments. If you don't have 2 years experience in either of those two, lenders won't lend to you. A DCR loan will give you a maximum of $5 million per year that they will lend to you. Now the difference, I'm not sure if people know about DCR loans, so I probably might be, I'm not sure if you guys do or don't know about it. So, excuse me here, I'm not trying to be condescending to anybody here. It's my first time here. So, DCR loan, right? It's what it is you have a home, so you want to do a home refinance, right? And a regular home refinance. So it goes off like how much you have, how much the property is worth, right? How much you have left for the mortgage, and how much you pay the mortgage, right? Well, a DCR loan is different. It goes on the TVL of it have a TVL of 1.2 or more. So basically, if the mortgage is $1,000, and then the people who are renting are paying like $1,400, you have a TVL of 1.4. So they'll they look at that. They look at the amount of money the property makes and not the value of the property. And for traditionally, it's a lot better to get those loans because, like right now, right? If you go for an investment loan on a property, you're probably looking around 9%, 10, right, on an investment loan. But if you do DCR loan, you're looking around 6 to 7. So it's a lot cheaper. Like especially right now with the higher rates, you're going with a DCR loan. The only thing is that money that they give you goes only towards the mortgage. The all the fees associated with getting the house and the money you had to put down, the 25% you got to put down for the property, you have to come up with all that money. You can't roll the lawyer fees and closing costs. You can't roll that into the loan. That money is just there for the mortgage of whatever left you didn't pay on the house. The DCR loan will pay on that house. So it's a good thing to get if you go with liquid cash. The DCR loan is a good way to go.
Thank you for bringing that up, Frankie. For those of you that don't know, he's saying DSCR loan, and that stands for debt service coverage ratio. DSCR loans come into play a lot of times if you are over mortgaged. And I learned that when I bought my 4th unit because they didn't want to give me any more normal person loans because I had mortgaged myself out of the normal person system. So I think we had Keely up next. Black Meta, what did you want to mention, Keely?
Hi there. I thought I would just be
Awesome.
listening while I do other things around the house, but I'm like, oh wait, hold on, I
That's
need to
what
stop.
happens to everybody.
Yeah. I was like, there, my situation is a little different. I don't have a mortgage because I bought my house through this organization, Detroit Land Bank. But I need to fix it up and all that stuff. Um, could I have a couple of questions? Can I get some examples of what you guys mean by paper trail? Since it was news to me that having a bunch of money in the bank is like not a plus as far as, so I would be using it more to get a home loan to for improvements of the house as opposed to buying a house.
So I think paper trail is only what we're talking about mainly is any large deposits need to be sourced. That's a paper trail. So if it's in an account
Okay.
now, you should be fine, right?
Mhm.
But if you're moving cash around, taking mattress money as we used to call it, right?
Right.
And putting it in an account, there's no way that you could source that. And if they ask for a paper trail, the underwriter, if you can't come up with a source of it, that's when you got to wait the 2 months in order for it to be used for a future bank.
Okay. So it'll have to be like income,
Like if you
or
got
a sale
of
from
property and you got a
property or something like that.
yeah, if you got a sale of a property and you got a closing statement that has X amount of dollars on it from escrow, just save that, and they'll probably ask for it to show because you're gonna have a large deposit on your bank statement. That'll wipe that out. Just got to prove it. Source of funds. Yeah.
Okay. Okay. And my other question is, can I get, I don't want to take us further down the LLC rabbit hole, but
Go ahead.
could I, okay, Angie, but can I get pros and cons between trust and LLCs, or can they be incorporated in some way, or are they entirely different animals?
I can kind of speak to that. An LLC and a trust are very different. LLCs will help with asset protection because it's a limited liability company. So you set up that entity, it's a business entity. And when you transfer your property into it, it gives it some liability protection. So let's say something happens on that property and somebody sues you, okay?
Right.
They'll sue the LLC because the LLC is what owns the property, and they can't come after you personally if it's set up properly and all of that stuff is done. They cannot come after you personally. A trust, like a normal revocable trust that most people have, do not have that kind of asset protection unless you do like an irrevocable trust, or there's other types of asset protection trusts out there, but a normal revocable trust does not protect you personally from liability. So those are kind of big differences when it comes to LLCs versus a trust. A trust, like a normal revocable trust, will help in terms of management of property. If something were to happen to you, if either you're incapacitated or you pass away, but anything that you put into your revocable trust, it's not going to be protected from each other. You know what I mean? Like, so if you have different LLCs, whoever sues you can only get at whatever assets are in that LLC, not past that. So that's
Okay. Can you just double up on that and have both the LLC and the trust?
yes,
Okay.
absolutely. So a lot of clients of mine have LLCs which we assign to the trust. So what they do is create the LLCs for the different properties, and then they assign all of those LLCs to the trust. And so if something were to happen to them, they are the owners of the LLCs, and then the trust, the successor trustee is able to take over if they're incapacitated, if they pass away, something like that. So yeah, definitely do both.
Okay, and this is the last one I have for right now. So I want to apply for like a home improvement loan. But the house, so before I do that, and I know I'll have to get a some kind of, what is appraisal for to even apply for a loan. Should I try and improve as much as I can to possibly increase what that appraisal is before I apply for a home improvement loan?
What do you think the value of the property is now?
Right now, it's 28,000. That's what that's what the city is calling the value, but it hasn't been officially appraised.
And how much you looking to get for a home improvement loan?
100,000. I want to add a sunroom to the house.
Okay. Did you say the value you said was 28,000?
Yes.
So you're not going to be able to borrow more than 100% of the property.
Okay.
Mostly cash out is 80. Mostly cash out is like 80%. Sometimes they'll go higher than that. So
what I'm asking is, should I just work to improve the value before I even think about, getting appraisal?
Where are you located?
I'm in Detroit.
Okay. So what I would say is get a hold of a lender in Detroit and ask them this question is, I don't want you putting a bunch of money in the house, because you're going to be appraisals are always with the 3 comparables in the neighborhood normally. So I don't know what your land is, and you could actually, you could go around in your neighborhood. I don't know where you're at, if you're in rural or if you're in the city, but you could pull information, right, on what the houses that were selling and the property selling for. It may be worth X amount of dollars already. You may be the $20,000 may not be correct.
Right. Okay.
What do you think on that, Angie? I don't want to spend her money. I'm thinking if we had to check the value of that property first and see what it's worth. Don't order an appraisal. There's other ways of doing it without needing an appraiser.
Right. And that's the thing, like, Keely, you don't want to bring in your own appraiser, because that doesn't matter anyway. Like, it's going to be the lender. You have to do everything through the lender if you're going to get a construction loan anyway. So that would just be a complete waste of your money, because you guys, an appraiser's value is just one person's opinion of what that property is worth at that one moment in time. And so it's constantly changing. Like, as soon as you buy it, it's changed. So you don't want to buy it until the lender makes you buy it. And then Keely is in a very interesting situation, because she purchased, I don't know if you guys have heard about Detroit Land Bank, but they basically sell the properties that everyone has abandoned in Detroit for like a very small amount of money, on the premise that the person that purchases the property is going to improve upon it and make it a livable, habitable property again. And so Keely's in the middle of that process, and you're doing a great job. We got to walk her property last summer, and it was super interesting. And I think that I think that your value is probably more than 28,000 at this point in time. But if you can only get a loan for 100% of the value, then it might be worth your time to do a couple of other things inside of the property right now to bring that value up, so that you can get a loan that is the amount for your sunroom, Keely. But I also think that we could get together on that workaway program and bring some caravan members over and help you build some stuff.
Okay, so you guys have offered before, so I'm definitely good.
Right.
And so whatever you decide to do with home improvements, just start a file on that, and when you do have an appraiser come out, make a copy of that file and hand it to the appraiser.
Right.
At that time.
Been done.
That's a
Okay.
really good
And
point.
so,
Yeah. And then if I was you, I would go talk to a local bank and see what they think the value is. You don't have to pay for that. You could just talk to a local, Angie, can you help her out with a value on that property, or do you think she's right around 28?
Yeah, I can put you on HomeBot at Keely, and then you can see what
That's what I was
HomeBot
thinking.
says,
Yeah.
and that would be
oh,
like an
okay.
AI average of it. And I know you've been kind of delving into that AI arena anyway, so it could be fascinating for you
Yeah.
to play with that anyway.
Hmm.
Most
And it's free.
definitely. Yeah, absolutely. Yeah, we
Awesome.
we
Yeah.
we like free things.
Yes. And we have to pay for so
Absolutely.
many other things.
Yeah, yeah,
I
absolutely.
can think
Very
of.
cool. Well, and I just love what you're
Okay.
doing with the property, and I Detroit is a really cool city and it should be revitalized. So I just want to give you major kudos for taking on a huge project that is going to make a big difference to your block and to your neighborhood. So good job.
Oh, thank you. Thank you.
Alrighty, so let's talk about a little bit about like kind of timing and purchasing properties. One of the sessions that we have for on the sessions page is um, from our podcasters, actually the educated home buyers, and it's Jeb Smith and Josh Lewis. They have a really good session that's talking to you guys about being prepared and buying in the off season. So their segment is really, really good for first time buyers. If any of you guys are looking to buy your first home, or hopefully you're trying to influence a family member to buy their first home, I would encourage them to watch this session because it's going to help you just with the proper steps to be prepared so that you can take action early. And they have the cliche, the early bird gets the worm. But if you're buying a property in the off season, what you're really doing is you're eliminating the majority of the competition. So, would you rather run a race against one person or like 50 people? Um, if your money is involved, you probably want to run the race against only one person. And so, the off season is a time when all of those other buyers that aren't, let's call them A paper, um, they don't get sidelined in the off season because the sellers don't have the luxury of just ignoring that buyer that only has 3.5% down because they might be the only buyer that's on the table right now. And so the best time to buy real estate is when you can. Trying to time the actual market is fruitless. But if you try to time the seasons, and realize when the hot season is in your particular area and when it's not in your particular area, you can save yourself tens of thousands of dollars, and a lot of headaches and a lot of heartbreaks. Because one thing that I'll see as a real estate agent is sometimes, like, if it is a crazy market, like some of my buyers that have a small down payment, they are making like 5+ offers in order to finally secure a property escrow. And it's discouraging when you get told no 4 times or you're not good enough 4 times. And it's just, so keep that in mind for trying to basically make more for your money and less headaches, that timing the market. And like, for example, in Southern California, our slow market is from November to February. So we are in the middle of it right now, you guys. If you know somebody that is got like just a small amount of money down, or if they're doing down payment assistance, anything like that, the time for those people to be acting and offering on properties is November through February. If they start to try to offer on properties come March 1st, when everybody else is in the market, they're like, I don't want to discourage anybody from trying, like miracles happen, but you're basically praying for a miracle at that point in time. So you can make things more realistic by timing your seasons. And remember too that not every season is like California's. So if you're talking about Florida, like their off season is when it's super hot in the summertime. Their on season is in the winter time when all the snowbirds want to buy. So keeping those types of things in mind, that the on and off season is different for every area. It's really important for you guys to remember also when you're buying a second home or a vacation home, because you don't have like pressure of time. Like you could buy it this year or next year, right? And it's not going to make that huge of a difference. So think about timing your seasons and things like that. Has anybody, oh, I see Frankie, your hand is up. Do you have any comments?
Yes, yes. So she's not wrong in what she's saying about the off season, on season stuff. You know, um, particularly though, like the top 15 markets in the country, they don't really have an off and on season, because when you go there, you'll see when you get a when you get a real estate agent and you look at the properties, the real good ones, they're gone within a week. So what I suggest for you, people who are new home buyers, not even just new home buyers, just if you want to buy more property, you, on top of what she's saying, which what she's saying is she's saying very good stuff, is if there's a divorce, and you can ask your real estate agent these questions. They have to tell you. They say they don't know, they're lying because they do know. If there's a divorce, if someone inherited the property, or if it's a short sale or a foreclosure, because those four things right there, they help you to it's a good negotiation tactic for you, and also too when you buy the house, that house will have more appreciation in it. Like when you get it, there'll already be more equity in the house. I was in the Navy. Right, and my four of my houses are in the Virginia Beach area. I got three up here in New York, and then I got I'm sorry, I got two in Florida. Now, I did that tactic in the beginning when I first bought my house. I bought the house for 105. The house was already worth 290,000 when I bought it, but it took months. I had to wait. I'm looking at houses, looking at houses. You know, the real estate agent tried to upsell me, which real estate agents will try to do that. They don't care about what you're looking for sometimes. Sometimes they worry about their bottom line, and in order for their bottom line, the higher the price, the more commission. So, make sure you got to make sure your real estate agent really is working for you, because sometimes they're not. Sometimes they're working on that commission and not caring about what you're really looking for. So,
That's a good point. Not all real estate agents are made equal, and some of them are, I call them transactional. They don't care if they work with you again. They don't care if they build a long term relationship with you. They don't care if they take your money. They don't care if you buy a bad investment. Um, I try to be the opposite real estate agent of that. And I do care about your future. I do care about you enjoying your property. And I do care that you make smart decisions with real estate, which is why we do this event, which is why we bring in all these people together. So thank you for bringing that up, Frankie. And it is a good point. Like what is going on with the seller of the property definitely can help you as a buyer to decide how much you want to offer on the property, and help you kind of know when you can hold the line or when you don't have to hold the line, because certain life circumstances like divorce do force a sale, so a lot of times. So knowing those types of knowing that type of information, it is helpful to you when you're making offers, and especially if you're in any kind of like a multiple offer strategic situation there. So thank you for bringing that up, Frankie.
can I say something else too, if you don't mind?
Sure.
So, if you So like, I never went to any seminars. No one taught me anything. Like I'm pretty much in the real estate game. I'm self-made. Like I'm self-taught, all this stuff. So how I look, so knowing that, right? I put all my eggs in one basket, and real estate is my bread and butter. Like I was able to. I retired before the age of 40 because of real estate. So I might kind of know a little bit about what I'm doing here. What I was doing when I want investment property, right? I'm looking at property appreciation, rental stagnation, laws for the tenant, laws for the for the landlord, right? How much I'm looking at migration, right? Where people are going. Um, how much money is that county paying the government, and how much money is coming back in, right? So my basis was in Virginia Beach area, where they're giving the U.S. government a dollar, like $1.35 per person, but they're getting back a dollar. $2 and $1.50. So they get it's a net positive, almost like $1.30, which equates to about $6 billion a year. That kind of money coming in is going to be able to help weather a storm, right? It's going to help. What I mean by a storm, like a recession, a depression. When you're by yourself doing this stuff, you kind of want to have that. And when versus stagnation, dollars depreciate 4% every year. You compound that year after year, your buying power goes low. If you're trying to expand, you're not going to be able to expand because the rent that was $1,000, say in 2025, it's still going to be $1,000 in 2030. It hampers you. And you have places like Scranton, Pennsylvania, where if you have a second home, and if that second home is used for rental property, the city wants 10% of your gross on top of you paying 10% to the property manager. So you're already at a 20% negative when you get the property. It's not like that in Virginia. Like, well, at least where I'm at. So you have to look at not just the state laws, you have to look at the county laws, you have to look at the city laws. There's a lot to look at. It's a layered cake if you want to be successful and if you want to try to expand on your real estate investments. So that's why I say that.
I like that. It is totally a layered cake, and every single area is completely different. You brought up a good point, is that like where you decide to have a rental property is you want to check with the city before you close on that rental property to see what kind of, like, do they charge a vacation rental tax or a short-term rental tax? Do they charge a long-term rental tax? Are they like Los Angeles, and the rent control laws are basically like, keep you in a landlord jail? These types of things are kind of important to know so that you make strategic, smart decisions and don't end up with something that you're kind of like stuck with and didn't realize that you've got these kind of parameters around you that you didn't want when you purchased the property. And so that's yeah, well, and I think that can kind of bring us to our little land segment, because I know, we're talking about generational wealth again. Thank you all who are just joined in and Homeownership Day. And one of the things that a lot of people forget about when they're talking generational wealth is like buying and holding land. Land can be an amazing purchase for you. And if you were with us in 2024, you might have watched the Dirt Rich segment by author Mark Podolsky. This year, we've got another useful land segment by the Acrewell Land Company, and that segment's called How to Spot Bad Land Quickly. You guys should totally register and watch that. He gives you like real strategies on how to quickly eliminate subpar parcels. And land is such a good long game because you can, just buy and hold it, and it's not going to appreciate like hundreds of thousands of dollars in your lifetime. Well, it may be, but it's, over generations, that land can be so very valuable. When I posted the game earlier today about the property prices and stuff like that, somebody commented about some land in San Clemente, and that was it's amazing what land will do for you over generations. I remember I had clients in Newport Beach that bought a little cottage on the peninsula, and it was $250,000. I sold that for $2 million 2 generations later. So these types of things is, think about buying land and holding it. And also, uh, for some of you guys, there's ways to monetize land, and it's just a little different. It's not like necessarily being your traditional landlord, but you can monetize land by doing a hip camp on your land, or letting people rent that out for like event spaces and things like that. So if you've not heard of hip camp, a way that you can be like kind of a mini landlord without having to deal with your, cleaning toilets and making sure the roof is okay and all that stuff, is you can buy a plot of land in a county that will allow you to park an RV on that land. And then you guys could just put that land up on Hip Camp, and people can go park their RV on that land for a day, a week, a month, and they pay you money. And it's kind of a cool way that you can start to monetize land. But the real money for land comes in owning it for generations. And I think it's a great thing to think about. A lot of people, like, you don't have a lot of competition buying land. So keep that in mind too. Like, if you have somebody, and it's really good if you have a DIYer and they don't like mortgages, they don't want to be attached to a mortgage in their younger years, like, they can buy land and buy an RV and live in the RV on the land while they slowly build up whatever structure they want to build that is a mortgageless property, because they're building it on their own accord over time. So keep that in mind as an opportunity. Another session I want to bring to you guys' attention is a really cool one about the monolithic domes. Because obviously, like, it's good to build on the land at some point in time. And when you build a unique property, those will sometimes sell at unicorn prices. And so I have been admittedly obsessed with dome homes for the last couple of years. If you were with us last year, you had the Mojave Project. They are a nonprofit, and they were talking about building super adobes. And that is a great one. Like, if you're a DIYer, is building a super adobe on your land. Like, you can literally do it with you and four other people, and take as much time or as little time as you want. And it's just a really neat thing. So I would encourage you to watch the Mojave Project's Super Adobe segment from last year if you have any interest in building on land. And then also the Monolithic Dome Institute's sustainable living inside of a dome home segment for this year, because they like, yeah, that I just go on monolithicdome.com, you guys, and check out some of these absolutely rad structures that this company is building. It's super duper cool, and it is creative, affordable structures that you can live in. And most people aren't aware of it because you don't drive down a block in a neighborhood and see a dome home, do you? It's very rare that you see that, unless you're driving through Taos and you're like one of the caravan people, right? But if you're, just normal individuals, don't usually see these dome homes. But I want you guys to know that there's all these new ways of building that are coming out, including the 3D print and stuff like that. I hope to have a segment on that one of these years as well. But the old way isn't necessarily the best way, so keep in mind some of these new, like, eco-friendly ways. One of the things I loved about the monolithic dome presentation is, like, that dome that they built, it was in Texas, and they had like a full on green water catchment system in it. And dome homes are also very stable in temperature naturally, so you guys are going to save on like heating and cooling bills if you choose to go that route. So just wanted to bring that up and say, hey, consider a dome home if you don't want something traditional, but you want to own something of your own and you like unique properties. Does anybody have any questions? Oh, I just saw Frankie's hand go up again.
I wanted to add to what you were saying. So like one of my homes I have, it's a three-family. It has a lot of land, and it has a garage. I turned that garage into storage units. Younger generations, like for millennials, Gen Alpha, Gen Z, they want to live in smaller places, but they're willing to pay money to while they live in smaller places to put their property possessions into storage units. So I turned that into 8 storage units, and I charge them $200 a month on top of that. And since there's so much land, I also charge the people who live on that three-family to park their car. They pay $75 a month to have a private parking. You don't have to worry about parking on the street. And it's pretty much adding on to Miss Weeks, what she was saying about, maximize the use of your land. Like, remember, you're bartering here. It's a business, and if you know there's more land than just apartments that people can live in, try to utilize that land to the best of your capacity and maximize the amount of money you can get off that investment that you purchased. That's all.
That's a super great point. Like, it doesn't even have to be a living structure, right? Like, depending on where you're at, you could be renting out a garage for parking. Like, if you're in Long Beach, that garage is going to go for top dollar, yo. There's no parking in that city. Um, but you know, or let's say you're in Michigan and you're on the water, like you can rent out that boat dock. That can be great money for you. People, a boat slip that's close to the lake, like they are going to pay good money for that. So if you're not a boater but you have a property on a canal or on a river, you can rent out your boat slip. You can do storage in the garage. You can build a second unit. And like Frankie was saying, that a lot of the younger generations, they want small spaces and they want small prices. So that's something that you can accommodate on your property and build what's called an accessory dwelling unit, an ADU, and you can rent that out. So if you're living in the state of California, if your property is zoned residential, 1 to 4 units, it is a state law that overrides all of the local, city laws and county laws. It is a state law that you are allowed to build an accessory dwelling unit on that property. And so, in essence, each and every one of you, with where you're at right now today, if you own a single family property, you can turn that property into a duplex. And so I highly, highly recommend to do that if you have the means. And if you don't, you can talk with Derek or your favorite lender about getting a cash out refinance to do that, or a home equity line of credit to do that. I personally like home equity lines of credit to leverage what real estate you have now, but without committing to like a whole nother refinance and resetting the timeline on your mortgage. A home equity line of credit, or a HELOC, acts as a large credit line that is attached, instead of to a credit card, it is attached to the equity on your home. So I always tell people, get a home equity line of credit before you need it. Don't walk into that open house and go, oh, now I want to get the HELOC for $100,000 to put down on that house. Have your HELOC available and ready, and then go into the open houses and things like that, because it will just help you guys out and be less stressed. But it's great to have a home equity line of credit available for your use at any point in time. And there's the banks aren't always your friends, but they definitely enjoy making money off of you. So I always like to tell the story of like Laguna Beach, and when they had their landslides happen a while back ago, the bank called everybody and turned off their home equity lines of credit. So it's important to like get it while you don't need it, you guys, because a lot of those homeowners would have used those home equity lines of credit in that landslide scenario to build back up some of the stuff in their home, and it got turned off. So turn it on and take money, utilize that. And because it's your home equity, right? As long as you're making smart decisions. And when I say smart decisions, I mean you're using your home equity to either improve upon your home, so that brings you more worth, more money on the property, or you are using that home equity to leverage property and buy more property. You are not using your home equity to buy Rolexes, to buy depreciating assets like boats or cars or any of that stuff. So I want to just say that and make sure that you have that kind of like a mindset. A HELOC is something that you should have and protect and utilize only in certain types of situations. Have any of you guys in the room have a HELOC, and how have you used it? Nobody's used a HELOC before. This is interesting.
I tried to get a HELOC. They wouldn't give me a HELOC unless it was a personal home.
Hmm.
They wouldn't give me on investment properties, which sucked. It would help me out a lot more, but I had to use whatever cash I was making from rental properties to help renovate and you know make the properties better for higher rent. But yeah, no. I wish. Well, that's in Virginia. I'm not sure what it is in other states, but I know in Virginia they didn't allow you to get a HELOC for homes that are not your personal home.
I've heard that too, Frankie. It's your personal home is going to be the most likely one that you can get a home equity line of credit with, and investment properties, because too many investors have bailed on those home equity lines in the past. I think that they don't usually do investor home equity lines of credit. But if any of you do know of it, an investor HELOC, feel free to comment that in the space and let the rest of us know, because I'm not really aware of one. And it's, again, a good reason why like, if you're thinking about building generational wealth just where you're at right now on your own single family property, then you can, in essence, get a HELOC, then use that HELOC to build an ADU, and then use the rent payments on the ADU to pay off your HELOC. And now your HELOC is still active, but it's at zero. Now that's your go button. So you can use that HELOC money again, but now you go and purchase a 4 unit outside of what you've already got going on. So now all of a sudden you went from 1 unit to 2 units, and then you're utilizing that equity to now get another 4 unit, and now you have 6 doors, and you're living in one of them still, but then you have 5 doors that are paying you. And this is how it all starts. This is how the snowball begins to roll down the hill and turn into this big, massive property portfolio that sends you mailbox money every single month. And that's something that we want to help all of you guys kind of learn to do, and make it like a household strategy, not just in our household, but in your household and in the people that you know and influence and meets households, because that is something that really is going to help all of us to live a better life and help each other out more. And that's really like a lot of the concepts about home ownership day here. So as we kind of like wrap things up, I just want to highlight that we have some, if any of you guys like are from a different country or you have roots in another country, a lot of us do, right? We're all immigrants in America, basically. But a good way that you can work on your generational wealth too is getting a property in the country that you're originally from. And a lot of times people are going back and forth to still see family members in that country, and dual citizenship and things like that. That can help make your life easier. That can help give you more choices, and that helps you to spread your risk, because if everything does blow up in America, who knows, maybe it will, maybe it won't, then you have a property in another country that you can move to in a worst case scenario, or that you can just go spend time and vacation and see your relatives abroad. So we have got some segments that we've done for Homeownership Day. Like this year, I apologize, I don't have a new international one for you, but we do have some great ones from previous years. We've got Dominican Republic, we've got Greece, we've got Philippines. Where else do we have? Jamaica Bon. So yeah, we've got some really cool international segments that you guys can go and listen to. And I think that that would be, it's just kind of fun to learn about that and international property. So consider that as well. One of the things that I wanted to bring up is like my session, I did 5 suggestions in tips to building generational wealth. And I think like a little hack that would be a good idea that some of my clients have done, but not all of my clients have done, but is to purchase a property, like just an entry level property, the year your child is born, and rent that property out until they turn 21 years old, and then sell your child the property for the price that you paid for it on the year that they were born. And so you're not gifting this child a property, right? This is not a spoiled child right here. What you are gifting them is the time in the market that they couldn't capture unless you were smart enough to do this the year that they were born. And so if you do that, then you basically had a cash flowing write off for a good portion of the time while you were doing it. And you now have set your kid up to win, and they can afford to buy a property before other kids can. So that's a really good way for you to just kind of like fast track generational wealth for your little. And another thing that you can do if you're like, no, Angie, I'm busy having babies, building nurseries, all that stuff. I completely get that. That's fine. So another way that you can help them is just as they, as they get older, talk with them about the value of owning property, what it's done for you. And then when they turn 20 something, you be willing to help them with a down payment. You'll remember that Derek mentioned that a family member can gift the entire down payment on an FHA property. Well, that's only 3.5%. So if we fast forward, or if we go back to like the little game that we were playing, the property that I bought, my first property was $156,000, and I put 3.5% down on that. So your if you help your 20 something with 3.5% down, it's better than waiting until they're 40 something to help them with 3.5% down, because think of about how much property appreciates over those 2 decades. And the stat right now is that the new first time buyer age is 40. Like, that is so sad, you guys. Like, do not let your friends and family wait until they're 40 years old to buy their first property. And I'm not saying if any of you are in this room right now and you are 40 or you're over 40 and you're renting, it's never too late to start. But the best time to start is 20 years ago or today. So those are the things I want to make sure that you guys kind of understand about generational wealth. Does anybody have any other questions or comments before we wrap it up? Oh, I see Frankie,
Yeah,
your hand's up
I
again.
see Frankie's hand, but we also had Desiree pop up a little while ago and drop back down. So I don't know if she still had a question or a comment that she wanted to share. But Desiree, you're welcome to pop back up as a speaker if you'd like to.
We always love to have you in the space, Desiree.
I wanted to add to that too. You could put your child to if your investment property, if you have it established as an LLC, you can have them work in your company starting at 7 years old up to the age of 23. And it also helps on your taxes. But they actually have to do some work. That work needs to be documented very detailed, very thoroughly, because the IRS will audit that. And if you're saying that your child's licking stamps and you're paying, 8 years old, but you're giving them $10,000, they're gonna write a note, already know you're lying. Now, but if they're licking stamps and you're giving them $1,000 or $1,200, that's more believable. But they're gonna look at tax evasion if you do it too high. So try to do it according to their age of what they really could try to do. But just document it very, very thoroughly. It's tax-free money and lowers the tax bracket on you as well. Um, like so I own so much property that my accountant said I'm gonna die not paying taxes because of the amount of depreciations I have with all the properties, and that helps too, because like if you're the one that's dealing with the properties, and say like your husband or your wife or your significant other is making money, those appreciations, while they're all set for you, they'll also offset her her job and her salary, and it brings down the tax bracket for her, bringing in more and more income for you guys as well, and less money you have to pay in taxes. But I'm trying to think what else. But yeah, no, just if I remember again, I'll raise my hand. But just wanted to add more context to what she was saying.
Thank you, Frankie. I think that's, yeah, I've seen some of those like Instagrams where you can basically pay your kids, and that can like help you offset taxes too. So there's a lot of different things. I always try to get a CPA to come on here, you guys, and it is so hard to get a tax person to come into like an open forum like this. They like to stay behind their little computer and their little tax bubble and all of that. But if any of you know a CPA or a tax professional that would be willing to come up here, we always would have them in the room.
Oh, Miss Weeks,
Yeah.
I also wanted to say too that you don't have to like be an investment a property investor to turn your house into an LLC. You don't. The thing is this: you don't want nothing in your name because, like, you have tax on you have inheritance tax from the government. You have inheritance tax from the state. Depending where you live, you have inheritance tax from the county and the city. So you don't want nothing, anything that of tangible assets. You want nothing in your name. Like everything that I own is not in my name. My car is in the business. My wife's car is in the business. Like even where we live, our house has its own LLC. You don't want it's easier, so it's not in probate. It's easier for less taxes. You probably won't have to pay any taxes at all. That's why it's good to have them in the LLC. You know, you put it into a trust and you put it in another trust because those degrees of separation, the further away you are, the tax liabilities like it goes down and it's just, and it helps your kids. Like they're gonna be like, "Why are you doing this?" But when you die and your kids see this, they're like, "Wow, my dad, my mom, they were smart in what they did," and it makes it so much easier for a transition for them to get the stuff that you made, the life that you built, you know, your blood, sweat, and tears, the fruit of your labor. It doesn't go to the state. It doesn't, you know, because everybody wants a piece of the pie when you die, but you have to keep that pie, and the whole pie gets to go to you to who you want to inherit it, and not to the state. So it's very important to do that stuff.
You're totally right. And having that like arm's length or degree of separation, it absolutely does protect you and in a lot of different ways. And this is like a forum about real estate, but I'm learning with aging parents that there's a reason that you want this arm's length for your assets when it comes to medical purposes and Medicare and Medicaid and all this too in the future. And like I'm not an expert on that realm, but another like kind of overarching theme of homeownership day is like surround yourself with good experts that can help you to protect these things. So I hope you guys are all following Amy. I hope you're all following Derek and follow Frankie. He's got some great real world advice for you, and make sure that you're connecting with your experts. Make sure that you don't just use like H&R Block for your taxes, these types of things. Like have relationships with the right people so that you have an easier life, so that you keep more of the money in your pocket. And paying these professionals to advise you is all a write-off when you have an LLC or a business. Oh, and that was another thing that I wanted to bring up when Keely was speaking about the land bank property. Like another thought is like put that in an LLC and take like an SBA loan. Why not? That could be something that you do as well. So oh, I see Desiree got up to speaker. Desiree, do you have any input?
Hey, just saw you for a couple minutes.
Welcome.
Welcome, and I'm glad Angie's doing this. Oh my gosh. Hi, everyone. Right. Things have been wild over here. So, someone was speaking, I think it was Frankie, I don't know who was speaking, about the different kinds of having different accounts and having every property in LLC and then having a separate bank account, blah, 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 blah.
Hmm.
So what we did years ago is we created in 2010 our family limited partnership to where and I live here in Orange County, California. And what happened is that when we set up our family limited partnership, it allowed that every single thing we own is in that family limited partnership. So my fur coats, my jewelry, my furniture, my cars, my properties, every single thing. Because what happens is that if you ever go to court and someone sues you, that what happens is that the idea is that they physically and they win. Let's say they win $1 million case against you. They have to pay sales tax and income tax on that money, that judgment, even though they don't collect the money. So if there's $1 million and you happen to be in the tax bracket of 35, 50%, whatever it is, you have to physically pay that tax to the various different government entities because the fact that is an award to you, even though you might not ever collect. And so the idea is that with that FLP, of never having to collect off of it and never have to pay if you never sell any asset or transfer any asset within that and keep everything within the FLP. If it comes out of the FLP, then that's where they can go after you. So the idea is that having that structure, so there's a lot of different ways of doing it. Because I used to represent several different companies and we'd buy them at the auctions and, put them in a separate LLC and go through the whole, rain dance of all that kind of good stuff. So things have evolved in over the last 20, 30 years. But I just want, there's also that different structure out there. I know it has evolved because back then it was $5 million that you could have as a limit. And then it goes and you have all of these different things as far as keeping your minutes up every single year. So just as a precursory, there's a lot of different ways to play with it. And because of the new rules and regulations, just make sure that you get in really good with very creative and very good lawyers because you got to protect yourself. And insurance is the number one thing that we all miss. And there's some new insurances that just came out to make sure that your writers are up to date and also to make sure that your blanket policies are out there because you can have a blanket policy or a liability policy that covers you while you're traveling, while you're home, because right now the theme is, let me just go sue the landlord for whatever reason they want, whether it's being robbed, whether it's being, I had a property that got robbed and they literally, we had to pay for it as the landlord, even though it was 95% probability, it was a former disgruntled employee against the tenants. So make sure you've got a lot of different things that are correlated to making sure you got it, because obviously weather issues and impact now because the storms that are hitting and things are coming through. So those are a couple gems that I wanted to drop out there.
Thank you, Desiree. I know you've got such good contacts and influence and connections when it comes to generational wealth because you work with so many people that have the family office space and they're very they are dialed in on all of these things. So thank you. And we didn't bring up the word insurance, I don't think, until you just mentioned this. So it is we brought up a lot of different ways to assure and put your properties into trust and things like that, but obviously we don't know when something bad is going to happen, and last year we were having homeownership day and LA was burning, you know and so it's something that you just don't know when you're going to need those types of things, but keep up with your insurance and make sure that you're properly covered, and in case something completely crazy or strange happens with one of your tenants, because you just never know.
Well, if you think about that from a property perspective, a liability perspective, but I hate to bring up geopolitical and things that are happening here in the United States, because you remember in 2017 I predicted that we were going to have an unsettling of what's going on without going on the political end of it. So does your insurance policy cover if someone were to come in and forcibly go through your property or go in there and rob you? Who covers that $50,000, $10,000 liability that happened to that bodily injury impact? Can they come after and sue you while you're in there saying that, hey, you didn't provide me a safe and secure place? They should have not allowed that to go in there. And I'll take a case in point. When 9/11 happened, the people who bought the property, Silverstein Properties, Silverstein family bought that property 6 weeks before 9/11 happened. They spent years, and I can't tell you how much, confidentially, how much money they spent to try to defend that they were not to be responsible for all the deaths of almost 3,000 people that died over the last 20 years, besides the actual impact of what happened with the planes, because they didn't provide a security infrastructure for the fact that a plane hit it. I mean, really? So the idea is that, so think about that. Really focus on your insurance, because getting to the asset and then having either sue you from a tenant, from a weather element, from a potential threat, robbery, what's going on with the government, what do you have covered? And think of the worst case, then it's never going to happen to me mentality. because that's the last thing you want to go through it. And that's where your corporate structures and that's where your playbook looks at. So I just want to not put the fear out there, but the thought process out there.
Thank you for that. It's important, and that is like we always want to keep it on a positive note, you guys, but in order to keep it on a positive note, like we have to be prepared for negative things to happen. And that way, when negative things happen, we just execute the plan that we've had in place when the negative things happen and bring in the professionals to help us manage that, and we can move on with our lives, and it doesn't have to be like an earth shattering, portfolio shattering, like bankruptcy type of a situation. So all right, well, I see Frankie's hand up, and then I know we are supposed to be ended soon, so we'll wrap it up after that, Frankie.
What I want to say too is that people who want, for property investors, don't really try to go into brick and mortar investments for properties because they're going away. Like a lot of brick and mortars, a lot of banks are in the red due to brick and mortars because of like people like Amazon and like Walmart, where they're just able to have these warehouses and get stuff, the next day versus buying stuff at the brick and mortar. So if you were to invest in stuff, warehouses, um, um, storage units, and regular, like apartments. So those that's the way to go, because the brick and mortars are going away. You're not going to make a lot of money on them because people are going to start being able to make stuff at their house, or going to be using, right now I think in I'm not sure if it's Austin or in Dallas, where Walmart is testing out where the drones are dropping off the stuff you want to buy. So they're not even using people like, truck drivers to deliver your stuff. They're just dropping it out of the air, onto your property. So just got to see where we're going, and then try to, invest smart, accordingly to how where technology is going, and where we're going as a future as a civilization. So just think about that.
Amen to that. Like it's we need to keep our finger on the pulse of what's happening not only in the real estate market but in like the consumer market, because a lot of that is going to drive what real estate is necessary. What are consumers doing right now? What do they want? What are they buying? What are they selling? And how can we accommodate them with the structures or infrastructure on how to manage that. So it's a really good point. Oh, I see Daniel's hand up, and then after Flower Done, we will officially end, I promise.
Hey, I know we're over on time a little bit and you're getting ready to close the space, but I just wanted to pop in. I've seen a lot of people come through that I know from the blockchain space, and it's just been a really cool event this year. Really well attended, and everybody's contributions have been awesome. I love following your journey, Black Meta, and Amy, Hannah, Derek. I look at connecting with you all behind the scenes. Um, to date, Homeownership Day has been kind of an annual cadence, which has been great. And something that Angie and I have been working on behind the scenes is like a curriculum or certification program for investment. And we are in escrow right now on our first property, kind of starting small, with something under 10K for vacant land, and lots of different use cases in mind for that. And if you're not already working in the blockchain space or in the know, it'd be a good opportunity to kind of go through the motions and get familiar with some of the tools that we're going to be experimenting with. And if you already are in the space, it'd be a really good fit and something that might resonate with you. Just kind of experimenting with DAO structure and governance on chain and smart contracts with fractionalized real estate ownership, and um, yeah, just experimenting with how to manage a treasury and things on chain. So something to kind of DM Angie or Flower Den account and see how you could get involved on the next one. And yeah, kind of some exciting stuff coming up the pipe.
Thank you for reminding me about that. Yes, we are. This year, we're looking for groups of people that just want to kind of toe in the water with really affordable properties and integrating with blockchain. So, if those ideas sound interesting to you, then definitely connect with Flower Done NFT, Daniel, or myself, Angie Weeks, and we can help you guys with some of just kind of take you on that ride and that journey of how things will look when we're purchasing property instead of in a group LLC, which is, well, let's call that the old school way, into a group DAO, which is what we expect to be the new school way. And thank you, Flower Den, for always supporting Homeownership Day and helping us with suggestions on speakers and meetups that we do across the country and things like that. We have our other sponsor, Vow to Save. Thank you so much for always being a part of it. Vow to Save is actually a crowdfunding platform for down payments. So if you guys know somebody who does not have the money for a down payment, they can basically register with Vow to Save, and then friends and family can help them crowdfund to get to their down payment quicker so that they can get into that home younger. And we went over the value of how important that is. I want to offer all of you homeowners on this space like a free monthly AI property valuation, like we talked about before. If you go to my X profile, I think my pinned tweet is got more information about that. But basically, no matter what state that you're in, I can set you up on a email digest where it just sends you like information about what your home value is right now and the equity that you have. And it's a great way to just kind of keep an eye on your values. And especially as you start to get more properties and addresses, like keeping them all straight, it's just nice to have in your inbox. So feel free to hit me up for that free kind of benefit for you. And I just thank you guys for attending today. Like, I know life is busy. We are all busy, and it is a lot when it comes to like trying to educate yourself about real estate and all of that. But like, Derek, Amy, like you, Desiree, you guys are all such like wealth of information, and I appreciate you bringing your expertise to the space. You are absolutely amazing. And again, everybody, please follow them, connect with us. Like, we are here to be a resource and a light for all of you guys. And I know we all have our own sets of talents and skills. So I want to end it and say, let's use them to empower each other and to build generational wealth, you guys. Thank you for an amazing homeownership day. And thank you, Alan, for helping me to manage the space. Thank you to my virtual assistant, Anna, for all the things that she's done behind the scenes. Like, there's a lot of people that work hard to put this on, and I just thank you.
Angie, I remember now. I know you're about to close. I'm so sorry. I remember what I wanted to say before. You were talking about the 3.5% being put down, which is good, but um, we got to tell the people about the PMI that if you put below 20%, you're going to be hit with PMI, and PMI is a good chunk of money that you. Some places, see, I was seeing some places where like $50 for PMI, other places up to $300 a month for PMI on top of your mortgage. So in any event, even if $50 a month, that's like $700, I think, for the year. I'm just doing quick math that you're spending, that $700 that you could have kept in your pocket because you were below the 20%. That they, that normally they would want you to not have. So you wouldn't have PMI. So like you should rule of thumb that people should try to put down at least 20%, so you don't have to worry about the PMI. And PMI is not an added cost to your on your mortgage. Am I right? I mean, could you explain more about that, please?
I
Just real quick.
I agree with you if you have the 20% to put down. Where I disagree with you is if you only have 3.5% to put down right now, and if you're trying to save that couple $100 a month or even $70 a month or whatever it is for the PMI in your area, like the math just doesn't math with that because properties appreciate faster than our savings account usually grows. And so you're constantly chasing this moving target, and it's better to get in with PMI than to pay rent because 100% of your rent goes to basically the trash can. And if you buy a house and you're paying PMI, then maybe 10% is going to the trash can, but the
So
rest is in your investment.
would you suggest that all right, to put the 3.5% down as a PMI, would that would you suggest that maybe would you be able to like refinance and then refinance your mortgage, but then have money to put down that could erase your PMI? Could you do something like that or no? I'm
Sure.
just asking for instance.
Absolutely. Well, and one of the things that you might not have been on the call yet or on the space yet, Frankie, but Derek brought up is if you do a 3.5% down, then you're stuck with that PMI until you refinance out of your FHA loan. But there's 5% down loans where you pay the PMI, it's less than FHA's PMI. And within 2 years, or when the property appreciates, usually 20 or 30%, depending on if it's an owner occupied or an investment, you can simply call the lender and say, okay, I've got 20% equity, and they'll drop the PMI without refinancing you. And that's the real cool part. Because then
Wow,
you get
wow.
in and you got to pay the PMI for only a short amount of time. But then you don't even have to refinance and reset your loan timeline. You just call the lender, pay for an appraisal. And if the property does then appraise for, it's like 20% or 30% equity, depending on if you're owner occupied or an investment property. But then once it gets to that point and the appraisal comes through, then the lender will just simply drop it.
Thank you. I didn't know that. I learned something new today. Thank
Yeah,
you.
so if any of you guys are on a PMI mortgage and it's not FHA, then call your lender next week and see if I can save you a couple $100 and if Derek can save you a couple $100. So, and if you're not and you want to learn more about it, remember Derek's always available for consultations and he even works weekends. All right, you guys. Well, thank you again for joining us today. I hope that you are walking away with some good information and a smile on your face because I know I definitely am. You guys all have a wonderful afternoon. Enjoy the rest of your weekend.
Thanks, Angie.
Thank you.